Understanding mergers and acquisitions, M&A. Mergers and acquisitions, M&A, represent a critical strategy in the corporate world, allowing companies to consolidate operations, enhance market share, and leverage synergies to encourage growth and profitability. This article delves into the complex landscape of M&A, explaining key terms, processes, types, and the implications for stakeholders involved. What are mergers and acquisitions? Mergers and acquisitions are processes by which companies consolidate. This can include whole companies or significant business assets through various financial transactions among two or more companies. The following are the most common methods involved in M&A activities. Purchase: a company absorbs another company outright. Merger: two companies join to create a brand new entity. Asset acquisition: one entity acquires some or all major assets of the target company. Tender offer: an offer is made to purchase outstanding stock of the target company. Hostile takeover: one company acquires another company against the wishes of the latter's management and board. It is important to note the distinction between mergers and acquisitions, although the terms are frequently used interchangeably. In essence, mergers indicate mutual agreement and collaboration, while acquisitions often denote one company unilaterally taking over another. Key takeaways. Acquisitions: one company simply takes over another. Mergers: a collaborative effort to create a new legal identity. Valuation: critical in determining transaction prices during M&A operations. Financing methods include cash, debt, or stock exchanges. Types of mergers and acquisitions. Understanding the different types of M&A transactions can help identify a company's intention and strategy. Here's a breakdown. 1. Mergers. Mergers involve companies agreeing to join forces to create a synergistic effect. For example, HBC acquiring Neiman Marcus Group and merging it with Saks Fifth Avenue aimed to create a consolidated luxury retail front to enhance competition against online retail models. 2. Acquisitions. Acquisitions involve one company obtaining a majority stake in another firm, often allowing the latter to retain its name and operational structure. For example, Amazon's acquisition of Whole Foods in 2017 enabled a smooth transition into grocery delivery services, effectively merging tech and traditional retail. 3. Consolidations. This type of M&A involves companies combining to eliminate competition. A notable example is Facebook's acquisition of Instagram, which not only bolstered Facebook's market share but also integrated the photo-sharing platform into its ecosystem. 4. Tender offers. In a tender offer, an acquiring firm offers to buy shares from the shareholders of the target company, bypassing management. A historical case includes Johnson & Johnson's tender offer for Amylyx Biopharmaceuticals in 2008. 5. Asset acquisitions. This involves a company purchasing assets from another company, often seen in cases of liquidation or bankruptcy. This transaction requires shareholder approval from the selling company. 6. Management acquisitions. Management acquisitions, also recognized as management buyouts, MBOs, involve a company's executives acquiring a controlling stake to take it private. Elon Musk's acquisition of Twitter in 2022 exemplifies this strategy. Structuring mergers. Mergers can be classified based on the nature of the relationship between merging firms. Horizontal mergers, involving companies in direct competition. Vertical mergers, involving companies at different stages in the supply chain, like a manufacturer and supplier. Congeneric mergers, involving companies that serve a similar consumer market but in different ways. Market extension and product extension mergers, involving companies selling the same or related products in different markets. Financing mergers and acquisitions. Financing can be achieved through various means, such as cash, using available cash reserves. Stock, issuing shares in exchange for target company shares. Debt, assumption of the target's debt or issuance of new debt to finance the acquisition. In some instances, staple financing might be provided by investment banks to facilitate larger bids. Valuation in M&A transactions. Valuation represents a critical aspect of M&A. Methods of valuation include price-to-earnings ratio, P/E ratio, comparing earnings with the known multiples within the industry. Enterprise value-to-sales ratio, EV/sales, offers a valuation based on company revenues. Discounted cash flow, DCF, calculates a company's value based on future cash flows. Replacement cost, valuing a company based on the cost of replicating its assets. Impact on shareholders. M&A transactions can have diverse effects on shareholders. Acquiring firm typically sees a temporary drop in share value compared to rising values in the target firm prior to takeover. New entity, post-merger, stakeholders might benefit from increased company efficiency and long-term performance that can lead to improved dividends. In stock-for-stock mergers, voting power can be diluted as new shares are issued, thereby decreasing individual influence among stockholders. The rationale behind M&A. Companies pursue mergers and acquisitions for various reasons, including market share expansion, reducing competition by acquiring rivals. Growth through innovation, gaining access to new technologies and intellectual properties. Operational synergies, combining resources to improve overall efficiency. Conclusion. Mergers and acquisitions are fundamental strategies employed by businesses for growth and consolidation. While acquisitions often represent singular company takeovers, mergers are cooperative endeavors leading to new corporate entities. Both processes involve complex financial structures and thorough valuations to ensure mutual benefits for involved parties, playing a significant role in defining market landscapes in various industries. Understanding the nuances of M&A can help companies make informed strategic decisions that drive success and innovation.